Well, welcome to Skills to Pay the Bills. This is Freeman Owen Jr. on our segment Just Ask Freeman. I want to welcome our viewers today. And I have my guest here, my co-host, Carolyn Owen. So we've been getting a lot of emails and a lot of tweets in reference to retirement income planning. So Carolyn, you've got a few of those questions that I'd like to address today when it comes to retirement income planning.
Yes, I've been reading some surveys, and a lot of consumers are afraid to take any kind of risk now with their money since they lost so much during the recession. So how can people generate an income without taking on too much risk?
Well, there are conservative instruments such that, and still they will have some type of risk. For example, you have bonds, which fluctuate, even though that is a conservative instrument. But there's insurance companies that offer various types of vehicles, such as annuities and fixed annuities, which guarantee and generate a lifetime income one cannot possibly outlive.
And are there any products that are totally risk-free? You know, I've heard people say that there are some products that are totally risk-free, but I'm wondering, are those statements 100% true?
Well, let's put it this way, pretty close. Now, as I mentioned, fixed annuities, fixed index annuities, life insurance, which generates cash value life, or I should say generate cash values, provide guaranteed income, spendable income. And of course, this is backed up by the claims paying ability and the financial strength of various insurance companies that's available to many of our consumers. So again, one way is to protect your retirement nest egg is to have a conservative instrument that generates a guaranteed lifetime one cannot outlive.
Okay. And we've also gotten questions about Social Security. You know, it's been said that by the end of 2013, there'd be $800 billion less than 2012.
Exactly.
Now, it seems like Social Security has the run-dry date gets closer and closer. Now, do you agree with this? And if so, why? And what can be done?
Well, you know that run-dry date, which was a few years ago, 2046. Today is 2033. Now, by 2016, if the revenues are not collected for that trust fund, there's a good possibility there could be a deficit. And number two, I look back, let's say in the 50s, 1950s, there used to be 16.1 persons per Social Security recipient. Today, there's only 2.8%. I should say 2.8 persons per Social Security participant. So the question comes to mind is, what happens as this run-dry date gets closer and closer? Well, the answer could be is that either generate more revenue through taxes or just print more money, and that can happen.
And I've seen your cards go out for your invitation to these seminars, and you always have this egg that you don't want to crack.
Exactly.
Now, how can we avoid cracking that nest egg?
Well, there's a lot of retirement income planning strategies that which can be employed. One of the things that we do when we interview a client is make sure that we set up an emergency fund. There's a budget. We look at the resources there such that can be utilized, not all the money, but some of the money can be utilized to purchase your retirement, to purchase a guaranteed income. So there are many means and methods, or I should say strategies, that we do employ that will help so many people out there that need our help.
Okay. And then you've gotten questions also about fixed index annuities.
Exactly.
And just how flexible are the fixed index annuities during these critical times?
Well, there's a lot of flexibility. Number one, there's liquidity options. Now, let me interject this, Carolyn. You don't want to use these type of vehicles as an ATM machine. You probably heard me say that on radio,
yes,
and seminars and other public speaking or other type of venues. Whereas you want to make sure that this nest egg will generate you a lifetime income to couple with your Social Security, or if you're lucky to have a defined pension program. But there's a lot of flexibility in not only fixed index annuities, but fixed annuities as well. Now, when you look at fixed index annuities, basically what happens is that you're tracking a major indice, and you get a chance to enjoy all the ups and no downs. It also can be utilized to pass on to your loved ones. You can generate an income for a specific period of time, a lifetime income. And again, I want to reiterate that it can be used for your loved ones, titling the beneficiaries properly so that your wife or your children and your grandchildren can receive the proceeds in the event of your premature death.
Okay. And something else I know I always hear you talk about, keep your money safe. You're known as the safe money man.
Exactly.
So how do you do the safe money management?
Well, the safe money management it basically involves setting aside, as I mentioned before, a certain amount of your resources, and don't subject these monies to any type of risk. Good example of risk. Let's look at let's say you purchase automobile insurance. Who's the risk on?
It's on the insurance company.
Exactly. Well, you have homeowners insurance. The risk, again, is transferred to the insurance company.
Yeah.
Well, why not insure longevity risk, inflation, and market risk? That's a good idea to insure your retirement. Take the risk off of you and place it on the insurance company. And that, again, that's based on the financial strength of that insurance company. That is very, very, and a very good rating for that insurance company. Remove the risk from you, all right, and place it on the insurance company.
Okay, and there are a lot of people out there that are selling annuities. But I'm just wondering, are there certain ages that are more appropriate, certain incomes that are more appropriate, or who is more qualified or for annuities?
Okay, now, annuities aren't for everyone. You must be suitable. Regulations, our state regulations in the Insurance Commission make sure that if you provide these type of products to individuals, they must be suitable. Now, suitability means that, again, it goes back to my old adage, you don't use that instrument as an ATM machine.
Yes.
So, therefore, when appropriate ages, it could be any age now, but specifically for my firm, I help individuals from, say, age 40 on up. And many of the younger age groups, when they when they graduate from college or whatever and take their first job, their second, their third jobs, they leave a trail of 401ks. So I'm able to consolidate those 401ks into an IRA, alrighty? But you don't want to take a lot of market risk. But in that younger age group, they can take some market risks because they can recover quicker than an individual, say, at age 55, 60 on up. Specifically, I focus more on the retiree, those who are retired and those who are preparing for retirement, getting close to that retirement age, and map out a game plan for them to follow, and to help those individuals have a very comfortable and worry-free retirement.
Okay.
Yes, I do.
Now, I was thinking that growing up, I think all boomers heard this, there's nothing certain in life but death and taxes.
Exactly.
So we know we're going to have to pay some taxes. There's no doubt about that.
Right.
But how do we prevent the IRS from taking most of our money from our retirement investments?
Well, I'm going to give you that answer, Carolyn.
Okay.
The main thing is I want to emphasize is that if you make money, you pay taxes.
True. There's no way to avoid
There's no way to avoid that. What if you spend money? You pay taxes.
Exactly.
All right? Now, you can't avoid that. And if you save money, you pay taxes.
Yes.
All right? Even if you die, you pay taxes. Well, the thing is, one way to handle or minimize the tax bite when it comes to the resources for your retirement income, utilize tax deferral and get as many of the deductions you can possibly get. Now, tax deferral is defined as receiving interest 3 ways on your retirement nest egg. Interest on your interest, interest on that principal, and then interest on the money that you would ordinarily have to pay Uncle Sam. So we utilize a lot of strategies, or employ a lot of strategies, such that tax deferral is involved. So you pay the taxes when you're ready. How about that?
That sounds good.
All righty.
Now, how do we avoid irreversible and costly financial mistakes when we're managing our annuity contracts?
Well, one thing about annuities, as I mentioned earlier, there are liquidity options. However, if you withdraw these funds, or you walk away with the monies, there are withdrawal charges that would be assessed that possibly could reduce the principal if you didn't accumulate enough interest. So that's why you have to be suitable. It's a long-term, and there are short-term contracts available to you. So you don't want to dip into your annuity and take more than the penalty-free amount that's available for you. And that's why we set up an emergency fund, so that it will take care of those occurrences where there's money that is needed for some type of emergency.
Okay.
All right.
And then I want to switch gears a little bit and talk about the IRAs, because there are different kind of IRAs, and I know there's the Roth. And what's about the Roth that's so special?
Well, the Roth is a very, very special instrument, because what you can do is get a distribution from that Roth, from your nest egg, if it's classified as a Roth, and get the distribution tax-free. Okay. There's a 5-year rule that you must adhere to, and if you take a distribution while you have your monies classified as a Roth before 59 and a half, there's a 10% penalty, and you could disrupt the infrastructure of the Roth IRA. I want to quickly say this before we take a break, is that the Roth IRA is not subject to a mandate distribution at 70 and a half. Now we're going to take a break at this point, and I want you to stay with us, and we'll be right back.
Hello? Patty, I've decided to follow your lead and file for Social Security benefits online.
But Kath, aren't you back in Zanzibar?
I just got on my laptop and went to socialsecurity.gov. It took less than 15 minutes.
Wow, you are a miracle worker.
Well, cheers, Patty. I'm off to film a baby rhino.
Baby rhino?
Well, welcome back. In the last segment, we were talking about the Roth IRA and how it's constructed. One of the things I want to continue that conversation, Carolyn, because the Roth IRA is a great vehicle, simply because there is a distribution that can be made to you tax-free, and it can also go to your beneficiaries, if you designate that properly, tax-free. Now, I've noticed that a lot of folks that have come to our firm, has made the mistake of converting their Roth by using monies in their traditional IRA, and they wondered why they were double taxed. Because the difference between the Roth IRA and the traditional IRA is, number one, like I said, the distributions are all tax-free. There's the 5-year rule, and those distributions can go to your loved ones tax-free as well. Now, we look at the traditional IRA. Now here, this is pre-tax money. Again, this money is tax deferred, and I think we defined tax deferred in our last segment. Yes. All right, now, anytime a distribution is taken, this money is taxed or treated as ordinary income, so it's 100%, it's all taxed. There's also a mandate. At 70 and a half, you must start taking a distribution from the traditional IRA. So that starts at 70 and a half. But something that's interesting about that too, there are a number of folks out there that don't take their RMD, that's what it's referred to, required minimum distribution, before December 31 of that calendar year in which they're supposed to take it. Well, there's a 50% excise tax on that. and therefore they're taxed on what they should have taken out, and there's a 50% penalty as well.
Very costly to the state.
What we do for our clients is we make sure that their RMD, required minimum distribution, is sent to them each and every year and is done automatically. And we set that up in our retirement income planning. And if folks would like to know a little bit more about the differences between the Roth IRA and the traditional IRA, we'll provide that information out on our website, justaskfreeman.com. You could tweet it or either go to Facebook and like all the resources that we have there, and it's all free. That's all available there when it comes to tax-free money versus tax dollars when it comes to your IRAs.
Okay. Well, let's switch the gear a little bit and talk about Medicare.
All right.
You know, Medicare was enacted in 1965.
Exactly.
To provide a safety net for qualifying individuals. But Medicare is kind of confusing, so could you just explain how Medicare works?
Yeah, you just retired last year.
Yes, so I've experienced firsthand.
And you had to unravel a lot of things there.
Yes.
But fortunately, we did some good planning, and we passed that information on to so many of our clients who were turning 65. This is a government insurance program. I look at it as, you can look at it, it's classified as Part A for your hospital stay, and Part B, which takes care of diagnostic tests, doctor visits, etc. And it, at a glance, you'll think that Uncle Sam has everything covered. Well, it doesn't. It only covers about 80% of your health care cost. All right, now, what happens to that 20%?
That's a good question.
All righty. Now, I know some of our viewers are saying, well, how will I get that 20%? Or they may say, well, I've got health insurance from my employer. But not all health programs are portable. That is, when you leave the job, your health insurance stays. So what do you need? You need some type of supplemental health insurance. A Medigap is referred to as a supplemental insurance. Or if you're fortunate, or I should say if you're lucky, to have an insurance program, a private insurance program that you could take with you once you retire, then that becomes the secondary insurance provider, while Medicare becomes the primary provider. I also want to point out too, the biggest thing you have to be aware of is the fact that you have to pay a certain amount of your hospitalization costs unless your visits are separated by fewer than 60 days. So in that case, you pay the deductible. A lot of folks don't know that, and you're required to pay this co-payment every day from day 61 through 90. So you also have a lifetime reserve of 60 days that can be used in conjunction with more than one extended stay. So Medicare is an excellent health insurance program funded, well, by taxpayers, of course, and it's a government program. But I would say get yourself, if you don't have the private coverage with you that was not portable, didn't come with you once you separated from service, make sure you have some supplemental retirement, or I should say supplemental medical insurance.
Okay, because Medicare alone is not enough to take care of our winter years.
No, it's not.
Now, how can we make our retirement years worry-free when it comes to health care? Because that's a big concern for seniors.
Yes, it is. As I mentioned, it's good to have, let me share this with you too. Speaking of health care, skilled care is on the rise. There are products now that have incorporated skilled care as a rider on various types of insurance programs or products, and also on annuities. That takes the worry out of being qualified to receive the escalating cost of skilled care. We're living longer. Our life expectancies have been extended, so there's a greater chance that we may need skilled care along with the escalating cost of health care. These are quite expensive. The expenditures for health care has risen. The average cost for a man is around $275,000 over his retirement years, and a woman's $344,000.
Because we live longer.
Exactly. You ladies live a long time, so therefore there's a greater chance that you will pay more for your health care. So it's very, very important that you have adequate health coverage in the planning for your retirement so that it can be worry-free. You don't have time to be sick, all right? Especially since we're living longer.
Exactly. Well, Freeman, I want to talk a little bit more about reverse mortgage now. Because I know when I open my mail, I get a lot of offers about reverse mortgage. So what exactly is reverse mortgage, and do you recommend getting a reverse mortgage to help fund long-term retirement costs?
Well, you know, it depends. Reverse mortgages they may be pretty good for those who are, I call the platinum group, that is 75 and above. But we have to be wary of the fees that are associated with reverse mortgage. Homeowners with second mortgages are more likely to be the ones who are considered underwater, that is, they're taking out a second trust. And they may want to have a reverse mortgage, that is, a mortgage where they don't pay the principal. And so therefore, they use the equity in their home, and they stay in the home as long as they live. But once they leave the home, they only have 1 year in order to pay that loan back. Oh. Now, I don't offer reverse mortgages simply because when you take that money to borrow against the value of your home, you might not be required to pay back the principal. But as I mentioned, there are substantial fees that are involved today, several about 10 years back. Now, the reverse mortgage, you're eligible at age 62. The older that you are, well, there's a greater possibility you have more equity. Yes. And there's a part of that equity that can be utilized as a resource to supplement your Social Security, or if you're fortunate enough to have a defined pension program, or any other resources that you may have. But it's likely that you or the heirs might have to sell the home. Okay. And see, that's the uncertainty of the risk of the market. I never offer to have one's home to be part of their retirement income planning because the value of their homes, they fluctuate so that wouldn't be a good idea to utilize your home as a part of your overall retirement planning.
Yes, because there's financial and there's an emotional.
The emotional risk.
Both of those.
And I've seen some of the children, the adult kids, say, "Well, I don't want mom and dad's house. Okay. We got our own." Okay. Or there may be the possibility that one would want a reverse mortgage. Get the reverse mortgage, and suppose that the person or individual whom they like to have the house bequeathed to, well, they don't have the appropriate credit rating in order to take care of that home and to finance it. Because again, once you leave that house, then you have to pay within 1 year whatever the value of the home is, and that's certainly it's very unraveling there with having a home there and no one else can utilize the properties.
And what are the tax implications for people using reverse mortgages to fund long-term health care and retirement strategies?
Well, some companies, I've seen some of the companies' applications. They say, well, these monies, where did you get these funds from to finance an annuity or life insurance? Did you use a reverse mortgage? Now, my philosophy, personally, I don't think it's a good idea for one to take their equity from their home and purchase life insurance, annuities, or bonds, or mutual funds, or any stock or anything like that. That's not my philosophy. But for some, a reverse mortgage may be good for them. But again, you have to be concerned about the fees involved, and they're pretty hefty fees. You bring a lot of money to the table when you get a reverse mortgage.
Okay.
All righty. Now, we've got about just a few seconds left here, and I hope that many of our viewers tune in, and if they have questions in reference to retirement income planning, they just go to our website, justaskfreeman.com. Like us on Facebook. You could Twitter us. We just launched a new podcast, Just Ask Freeman. There's tons of resources there pertaining to retirement income planning, and it's all free. And when we have our consultations, we don't charge fees.
That's true.
All righty. Thank you, Carolyn. I want to thank everyone that tuned in this week, and I want you to tune in the next time to Skills to Pay the Bills, where we have our segment, Just Ask Freeman. Our co-host, Carolyn Owen, will be along with us the next time. And again, thank you for tuning in.